who to lend new money, because it's new money creation. It's newly added to the money supply, and that has an impact. I mean, anyone can see this. If you suddenly print money and pump it into an economy, it will do something. Depending on where you put it, it will have an impact. If it is existing money, not newly created money, but existing money, you're simply shifting it from A to B, a shift factor, then yes, you have a gross impact here where you're putting it, but you have a gross negative of equal size somewhere else. You're just transferring. There's more here, but there's less here now. Therefore, the net effect will be very small or zero. Whereas, and that's true for other transactions when no banks are involved. But when banks lend money, the key thing is this is new money creation. And suddenly you immediately see why we have asset bubbles, property bubbles, real estate prices going up a lot for several years. What's happening here? Well, it's because it's funded. This is asset purchases funded by banks. And when they lend for asset purchases, it's new money creation. It's you're printing money, you're pumping into the property market, you get a property boom. And so that's why I warned in 2003, I warned in my book, New Paradigm in Macroeconomics, that the ECB, which was brand new, it only started, and I give the reasons, you can look it up, but the conclusion was I expect the ECB now to create massive asset inflation property bubbles through excess bank credit creation, which result in bank crises and bank collapses, which will result in big recessions and large-scale unemployment in the Eurozone. And this is, of course, exactly what they did in Ireland, in Portugal, Spain, Greece, and a number of other countries, where the banks created too much money for asset purchases. That's always unsustainable and always leads to problems. What you need to do instead is, that's the good bank behavior and the good bank credit, where banks help the economy and there's no crises. If you can ensure, and central bankers, regulators could ensure this, that banks mainly or entirely lend for investing, business investment in productive purposes, then you get more goods and services through this productive investment and higher value added, and you get income streams to service and repay these loans. And that's sustainable. You get high economic growth and no crises. That's, of course, what Japan did, what China did, Korea, Taiwan. You can have double-digit economic growth. Even European countries could have that. Very high economic growth, no inflation. You just need to make sure bank credit is used for productive purposes. But if banks create credit for asset purchases, in the short term, it looks great. And a lot of people can earn a lot of money in the short run. But it's never sustainable, because it's a Ponzi scheme. It's like a pyramid scheme. And at some stage, as soon as it only works, it can work for many years, but as soon as new credit creation for asset purchases by banks, as that slows, if the music stops, then the whole thing collapses. The house of cards collapses. You have non-performing loans. The banks then reduce lending further. Then that means there's less money. Asset prices come down. Companies go bankrupt that borrowed, they're overexposed. Banks have more non-performing loans. Ultimately, banks go bust. Credit shrinks further. The whole economy is affected. Unemployment rises. We've had this so many times in the last 250 years. It's nothing new. And it's whenever you create credit for asset purchases. So I showed this actually in 1992 in my quantity theory of disaggregated credit. I showed the link between bank credit creation and the economy and asset prices and also capital flows, actually. So it's been quite a useful little theory, which has stood the test of time very well. And it shows that we can prevent asset bubbles. We can prevent banking crises. We don't need complex bank regulation. This just puts a burden on small banks if we have such complex bank regulation. That's why since the ECB started business, almost 5,000 banks have disappeared. These are the small local banks, cooperative banks, community banks. They've disappeared in the Eurozone because they've stepped up always as solution, have more regulation. But it's the wrong type of regulation. That doesn't help. And the wrong interest rate policy.
Before we go further into the boom and bust cycles and ECB, just one question. When back in 2008, I interviewed Hugh Hendry at Eclectica in London, he pointed the finger at the 99 removal of Glass-Steagall Act and called for reinstating it. It seems nothing has been done in this regard whatsoever, of course.
I would entirely agree with him that the Glass-Steagall Act served a purpose. Remember, it was introduced in 1933.
Yeah.
As they saw what went wrong, it was first the banking and financial crisis and then the beginning of the Great Depression. And they said, oh, we need to separate the speculative banking from the more utility banking, deposit banking for the real economy. That, in a way, you could argue it's not precise, but it was a simple way that in those days, the regulators with far less data available than we have tried to achieve what I've told you, that we need to make sure bank credit creation goes mainly into the real economy for productive business investment. And the whole speculative thing shouldn't be funded from bank credit. And that really, in a way, is what this Glass-Steagall Act tried to achieve. Now, because it wasn't fully articulated, and therefore was also not entirely congruent in terms of the wording, it wasn't perfect, but it went a long way because it did separate. For example, look at JP Morgan. It used to be JP Morgan Bank. And because they were then told by the lawmakers, no, all your financial speculation bit, you have to break out. They had to create a new company. Morgan Stanley, which was a securities company, was broken out. And that's an example. And the idea was, okay, and JP Morgan does more the real economy lending, more traditional banking, and the other guys do their speculation, but they don't have a banking license. They're a securities company. They can't create money. And that is very sensible. And that's very close to, in spirit, to what I've been saying, and also what my quantity theory of disaggregated credit says. And therefore, and when this was abolished under President Clinton in 1999, suddenly it makes it much easier because now banks creating money could plow in much more actively into the financial speculation. And of course, then bank credit was much more diverted for asset markets. So I entirely agree with this analysis.